Good evening. Tonight we turn our attention to a force that quietly shapes the rhythm of our daily lives: oil prices. In our interconnected world, oil prices are more than just numbers. They're the pulse of the global economy, influencing decisions in boardrooms and households alike. Every barrel shipped across oceans connects distant nations, weaving a complex web of supply, demand, and expectation. Every shift in price ripples across continents, affecting everything from your morning commute to the strategies of world leaders. Whether you're filling up your car or a government is planning its next move, oil's value is a constant consideration. Today, November 20th, 2025, that pulse is erratic, reflecting deep uncertainty. Markets are reacting to a whirlwind of news, and volatility is the new normal. The drama of oil prices involves not just traders, but diplomats, generals, and engineers, all shaping the market's fate. Behind every price movement are negotiations, technical innovations, and sometimes tense standoffs that play out on the world stage. When prices surge, it can fuel inflation and strain budgets for families and businesses. When they fall, it may signal economic trouble, job losses, or even political unrest in oil-dependent regions. This week's wild swings, sharp drops, and sudden rebounds are driven by inventory data, shifting alliances, geopolitical tensions, and looming sanctions. Each headline can send shockwaves through the market, leaving analysts and everyday people scrambling to keep up. The world is watching as these forces collide, wondering what oil's next move means for global stability, economic growth, and even the price of groceries at your local store. As we break down today's market, remember, these numbers are symptoms of a world grappling with conflict, competition, and relentless energy demand. The story of oil is the story of our times, and tonight, we'll explore what it means for all of us. Let's dive into the numbers, a story of dramatic reversal. Just yesterday, oil prices plunged over 2% as fears of oversupply dominated. But by Thursday morning, optimism returned, and prices began to recover. Brent crude futures rose by 20 cents to $63.72 a barrel, while US WTI climbed 22 cents to $59.66. These aren't huge jumps, but they mark a clear pushback against the previous day's pessimism. This rapid seesaw is classic market uncertainty, traders reacting to conflicting signals. The question: what changed overnight to halt the slide and spark a rebound? The answer lies in a collision of factors: surprising US inventory data and ongoing geopolitical rumors. The rebound isn't stability, it's a market in flux, desperately trying to price in an unpredictable future. Every headline now has the power to swing sentiment and prices. What exactly triggered this sudden wave of optimism across the oil markets? Investors and analysts alike were caught off guard, scrambling to make sense of the dramatic shift. The spark was a bombshell announcement from the U.S. Energy Information Administration, or EIA, the agency that tracks America's energy data and trends. Their latest weekly report revealed that U.S. crude oil stockpiles had plunged by a staggering 3.4 million barrels, far surpassing the modest 600,000-barrel drawdown that most experts had forecast. This unexpected drawdown sent shockwaves through the market, signaling that demand for oil was much stronger than anyone had anticipated. Overnight, the entire outlook flipped from caution to confidence. So, what's driving this sudden depletion of U.S. oil reserves? For starters, American refineries are operating at near maximum capacity, churning out gasoline and diesel to meet both domestic and international needs. At the same time, export demand for American crude is surging, with tankers lining up at ports to ship oil to Europe, Asia, and beyond. U.S. oil is increasingly seen as a reliable source for global buyers. This powerful combination, robust refinery activity and booming exports, has rapidly drained inventories, sending a clear and powerful bullish signal to traders everywhere. The U.S. has now cemented its role as a major energy exporter, and its inventory data has become a crucial barometer for the entire world. What happens in American storage tanks can ripple across continents. When there's a big draw in U.S. stockpiles, it means global supplies are tighter than expected. That's exactly what reversed the market's downward momentum and reignited bullish sentiment. The EIA report didn't just update the numbers, it completely reset the narrative for oil traders, investors, and even policymakers. Suddenly, oil bulls had new ammunition. The market's focus shifted almost instantly from fears of oversupply to concerns about tightening supply and rising prices. In today's hyper-connected oil market, a single data point can trigger a global reaction. The stakes are high, and every report is watched closely. This week, the U.S. inventory report was that pivotal data point, one that changed the conversation in trading rooms from New York to London to Singapore. It's a powerful reminder that in a volatile market, surprises, especially from the world's top oil producer, can move prices at lightning speed. And this week, the surprise that shook the market was all about American oil, proving once again that U.S. data can set the tone for the entire world. Despite the bullish U.S. data, other powerful forces kept oil prices from rallying further, reminding traders that the market is rarely driven by a single headline. Even as optimism flickered, uncertainty loomed large. The EIA also reported rising gasoline and distillate inventories, an early warning that demand for refined fuels may be softening. This uptick in stockpiles suggests that despite strong crude draws, end-user consumption isn't keeping pace, raising concerns about the health of the broader economy. If refineries are running hard but fuel is piling up, it hints at slowing consumption. This disconnect between refinery activity and actual demand can be a red flag for investors, signaling that the market may be out of balance. This bearish signal tempered the excitement over falling crude stocks. Traders, always wary of mixed signals, began to question whether the recent rally could be sustained in the face of these warning signs. But the biggest shadow is the fear of global oversupply, tied to the Russia-Ukraine conflict. The geopolitical landscape is shifting, and the potential for a sudden surge in supply is keeping the market on edge. Rumors of a U.S.-drafted peace plan raise the possibility of sanctions on Russian oil being lifted. Such a move could dramatically alter the global supply picture, flooding the market with millions of barrels that have been kept at bay by sanctions. If Russian crude floods back onto the market, it could overwhelm already ample supplies. The prospect of a sudden influx of oil is enough to make even the most optimistic traders pause, as storage capacity and demand may not be able to absorb the shock. Traders are wary. No one wants to bet on higher prices if millions of Russian barrels suddenly return. The risk of a price collapse is real, and caution is the prevailing mood on trading floors around the world. This specter of oversupply is capping gains, even as U.S. data tries to push prices higher. The market is caught in a tug-of-war between bullish fundamentals and the looming threat of a supply glut. The market is caught between hope for peace and fear of a supply glut. As headlines shift and new developments emerge, traders must navigate a landscape where optimism and anxiety exist side by side, making every move a calculated risk. The rumored U.S.-backed peace plan for the Russia-Ukraine war is the market's biggest wildcard. Leaked details suggest Ukraine might be pressured to cede territory for peace, a controversial proposal. For oil, the key issue is sanctions. Any deal would likely relax or remove restrictions on Russian exports. That would instantly reshape global energy flows, unleashing millions of barrels of Russian oil. The mere prospect of diplomacy has calmed some market fears, hinting at stability. But the risk of a sudden supply surge is real, especially if demand is already showing cracks. The market is walking a diplomatic tightrope, hope for peace versus fear of a price-crashing glut. Every new rumor or leak sends prices swinging. The stakes couldn't be higher for both energy and geopolitics. Adding to the drama is a looming U.S. deadline, tomorrow, November 21st. All companies must halt business with Russia's oil giants, Rosneft and Lukoil, or face severe penalties. This is a major escalation, targeting the heart of Russia's oil industry. The world is watching. Will the U.S. enforce these sanctions strictly, or use them as leverage in peace talks? The deadline puts immense pressure on global businesses and the market itself. If enforced, it could choke off Russian supply and push prices higher. But the contradiction is clear. How can the U.S. push for peace and tougher sanctions at the same time? Is this a real threat, or a bargaining chip? The uncertainty is fueling wild price swings. Traders are left guessing, and every new headline could tip the balance. The market is bracing for impact as the clock ticks down. With so much uncertainty, analysts are in high demand. Many are skeptical about the peace plan's chances, especially if it requires Ukraine to cede territory. This skepticism tempers fears of a sudden Russian supply surge. Still, the fact that diplomacy is even on the table signals Washington may want to de-escalate. The market is caught between bullish U.S. data and unpredictable geopolitics. Prices are now driven by headline risk. One news alert can send them soaring or crashing. Analysts advise bracing for volatility. Strong demand supports prices, but peace rumors cap them. The result? A market trapped in a narrow range, waiting for the next big clue. Nervousness rules the day, and every development is magnified. The oil market is on edge, with no clear direction in sight. Why does all this matter beyond Wall Street? Oil prices directly impact your daily life, at the gas pump, in grocery stores, and on your heating bill. Higher crude prices mean higher costs for transportation, food, travel, and home heating. This drives inflation, squeezing family budgets everywhere. Governments and central banks watch oil closely, knowing it can slow growth or trigger instability. Even falling prices can signal trouble, like a slowing global economy or turmoil in oil-dependent countries. Today's market tension isn't just financial drama. It's about the cost of living for billions. The stakes are real, and everyone feels the impact. As the day ends, the oil market remains unsettled and on edge. Strong U.S. demand and tight supply are pushing prices up, but geopolitical uncertainty keeps a lid on gains. The looming U.S. sanctions deadline and peace rumors have created a volatile tug-of-war. The market is trapped between today's reality and tomorrow's unknowns. All eyes are on the sanctions deadline and any developments in the Russia-Ukraine conflict. Until there's clarity, expect the price seesaw to continue. The story of oil is now a story of war, peace, and economic survival. The world waits, and so do our wallets.